Well, good evening, everybody. I am Anuj Mehrotra. I am the Dean for the Scheller College of Business at Georgia Tech, and it is my delight to welcome you all, and particular delight for me to host today Jon Gray, who is the President and COO of Blackstone. Really thankful for you to be here, and what a lovely crowd we have here today.
So, love being here.
Great, welcome. So, Jon, you made headlines recently with a $125 million donation to Tel Aviv's University Faculty of Medicine. I'm really curious as to what drives your philanthropy. Why do you think this was very important? Tell us a little bit.
Well, I'll start with the overall theory of the case for me and my wife on philanthropy. We grew up never expecting to have the kind of life we have today. I grew up in Chicago, my wife in Philadelphia, and I don't know, 12, 15 years ago, we said, look, we've got to think about how we're going to give back and do it in an organized way. And we really focused on two areas. One was low-income kids in New York City, giving them access to education, opportunity, and healthcare. And we spent a lot of time on healthcare in particular and on helping kids from underprivileged backgrounds having access to health education and becoming doctors and so forth. And the second thing was the BRCA gene mutation, which is something that causes a very high incidence of cancer, particularly in women, breast and ovarian cancer. We lost my wife's sister to a BRCA-related cancer. And we set up a center at Penn, the Bassler Center, and have supported a bunch of other research institutions. After October 7th, we were deeply concerned about the state of Israel. My wife and I are Jewish, our families feel a real connection there. And we've been concerned, what could we do to help and really have an impact? But then we were thinking about how could we align with what we do here back in the US? Again, a focus on healthcare, on research, on access, and they're also helping underprivileged kids get educations. And so we decided, we could build dormitories, we could help with scholarships, we could do all sorts of things around labs and research as well, do some BRCA research, and we could help kids who otherwise have a hard time getting medical educations. We're doubling the number of Arab Israeli doctors as well that are going to graduate from there. So it was really a motivation driven by the unthinkable acts of October 7th, but doing something that was around healing, education, and opportunity, and it really tied with what we do back here in the United States.
Very inspiring, very inspiring indeed. So thanks for that, indeed. So I'm going to now focus on more of the financial side here. And you have been at Blackstone for quite some time. I'm not sure if you've been married longer or you've been at Blackstone longer, but one of the things is true.
I've been dating my wife. I've been married 30 years coming up. I've got my anniversary. I got to get that right here in a few weeks. But I met my wife I asked her out on the first date in February of 1992, and it was about 3 weeks later that I got a job at Blackstone. So I have the most boring biography of anyone you'll meet.
And I'm not going to mention when I met my wife because I don't remember.
Yeah.
And I'm on camera as well. So but tell us a little bit about your beginnings and tell us how you ended up being at Blackstone and what has kept you there for so many years.
Yeah, so I guess it just starts with, I grew up in Chicago. I'd never been to the East Coast until I went to college at Penn. I think for me, I did well enough in school, but I was really focused on sports more, and I was lucky to get to a school like Penn. And then I got there and I met all these very motivated people. And one of the great things about going to a school, like your own experiences, I'm sure, at Georgia Tech, is you find these highly ambitious people and it motivates you. And I decided to get a dual degree. I was an English major, and then I got into Wharton in finance. I had to do summer school courses at Northwestern to graduate on time. And that senior year was that formative year where I meet my wife and I get a job at Blackstone. And I didn't, why did I go to Blackstone? Well, they were doing this thing called the LBO business. Today we call it private equity. They had a bunch of notable people who had been prominent in business and politics. Pete Peterson had been Commerce Secretary. Steve Schwarzman had run M&A at Lehman Brothers. Roger Altman, David Stockman, a bunch of notable political figures. And I was sort of a political junkie too. And I had a friend who worked there, and it all sort of came together, and I got this job. And when I got to Blackstone, what I found was there basically was, this little place that had 70 people. We did M&A advisory work, and then we started they were doing private equity deals. And about a year into it, and it was great training because the firm was so small, the real estate market had collapsed, and Pete and Steve, the co-founders, said we should go into the real estate business. They found a great guy named John Schreiber, who happened to be from Chicago, and they didn't have any junior people, and somebody's like, hey, do you want to do this? And honestly, I was like, well, maybe I don't have to go back to business school if I do this. And I joined this fledgling unit, and I worked in that for the next 25 years, and we grew that to be the biggest real estate investment business in the world. And then 7.5 years ago, Steve Schwarzman said to me, hey, my predecessor, Tony James, was stepping down. We'd love you to take over the firm running it day-to-day as president and COO, and that's what I've done. And the reason I've stayed at Blackstone the whole time is because I love what I do. I love the people. I love the intellectual challenge of investing, because investing is really thinking about where's the world going? How's it going to look like? How can I invest against that? I love that. It's like sports. You get to see if somebody gives you $1, does it become $2? Do you lose the money? I love the quality of the people that I got to work with. And I've always, every day that I've been there for 33 years, I feel like I'm learning something new. And I think that whole thing, the nature of the investing business, the intellectual challenge, and then being around great people and being at a place where you really are trying to win, but do it in the right way, operating with integrity, that has been incredibly special. And so, I just think, and Steve Schwarzman himself, just so much drive, so much energy, and it's created a really special place. And I've felt very blessed to have landed at the right spot. And I often say that luck has been a core competency.
Well, thank you very much for that. So this is very different from a lot of folks who go into companies now and, in their third year, they're already on the fourth company. And there is something about Blackstone that must be there for you to stay for this long. And I bet, and I have been talking to a lot of alumni in New York City during this visit, and they all point to the culture of Blackstone. So what is so special about the culture of Blackstone, and is that intentional that is keeping people?
I think it is intentional. I think it starts with this idea that you want to be excellent in everything you do, that you're striving to be the best investment firm in the world, and you want to make sure your returns are great, but every element, your accounting, your legal, your technology, you want to be the very best. And it's a little bit like being on a winning team, right? A basketball, football team, whatever it is. There's something about a team that strives for excellence in everything they do. And then I would say it's also a place where we care about people. Now, we demand a lot of people. I'm not going to say this is an easy 9-to-5 place. This is a place where there are a lot of demands on our employees, but also where we try to recognize people when they do a good job, thank people, try to create a good culture. But related to that is, if you're going to attract and retain great people, you want a great culture where people feel good, but you also have to have a real meritocracy, where somebody who is super talented can have the opportunity to rise up. And so I think it's the combination of just this idea of we have this strong desire to win, we're trying to create a place where people are nice to one another, and we're trying to recognize real talent. And if you can do that, you can create something really special. And I also think if you feel like you have a mission, and for us, it's delivering great returns, which still the majority of the returns we're delivering are to public pension plans. So nurses and firefighters and teachers and all sorts of people out there, that it's really important we do a great job. I don't know, there's just, I think there's an incredible sense of pride, and there is this, also I'd say that it feels a bit like a small business, even though we've grown to be very large, where people really care, and it runs all the way through the organization. But I do think as much as anything is having a meritocracy where somebody young here could join the firm and feel like, wow, I could have an amazing career, really incredible professional development, but also financial success. And it's not, oh, I'm a seventh year this or so forth. I think that's really important to keep driving things. And then the final thing I'd say that I think is super important is, because we're a growth-oriented company and we're not a static business, that creates opportunity. So if you think about a static business and, we're in one line of business and this is what we do, that may be great and you could do really good, but how does somebody move up? At our firm, because we're going into infrastructure, we're going from Europe to Asia, we're moving into a higher returning or a lower returning version of real estate or secondaries, that's creating lots of opportunity. And I think that's been another way we've been able to retain great talent, is by continuing to expand. It creates more runway for people who really want to grow.
Great. So when you were talking about meritocracy and also talking about nice people, I was just hearing you were just talking about Georgia Tech students, I think. So that's great. So, but really, you make it sound so much fun working in this area and all that. But especially during turbulent times, this is not an easy job, right? This is not for everybody. No. And I know we are in turbulent times to some degree even now, but it has not been the first time that this is, in 2007, you took Hilton worldwide. So tell us a little bit about that, and how do you handle the kind of pressure that turbulent times bring, the uncertainty brings?
Well, I would tell you by definition, investing is difficult because by its nature, things are going to go wrong. There can be natural disasters. Some human being could break the law. You could have just made the wrong call. The technology management team missed something. So many things can go wrong. And then you have these systemic shocks, which you hit on. And the most notable clearly was the financial crisis. And for me at the time, we had bought Hilton for $26 billion. We borrowed $20 billion, which was a lot of, in retrospect, was probably too much leverage. But I was young. We bought it. We paid a big premium to the public share price, and we closed on the transaction at the end of 2007. And Lehman Brothers, collapsed a year later, less than a year later. And within 6 months of that, the company's same-store revenues were down 20, the cash flow was down 40, and we had put a lot of leverage. And you probably should have been writing the obit for my career at that moment. Because we had put $6 billion of equity, which was the most ever in a transaction, and we'd put it into our private equity fund and our real estate funds. And so we went all in a pretty concentrated way. I guess, how do you maintain balance? I think for me, having an amazing wife and the kids at the time, just sort of having something that's a touchstone that provides balance, I think was really helpful. I did fundamentally believe that this was a great business, that it was cyclical, what was happening, that travel is something we're all going to do, and that this business model in particular, which was primarily asset light, you were a manager or a franchisor, it owned some legacy hotels, but its growth was all from growing Hampton Inn and Hilton Garden and Hilton and DoubleTree and Embassy Suites and all these amazing brands, and that we just needed to make it to the other side. And so you had to stay calm in the face of this. We ended up putting $800 million more to deleverage the company. We had a lot of very nervous investors. We wrote the investment down by more than 70%. So imagine those meetings with our customers. Those were not fun. But I did believe, and a number of my colleagues did as well, that we were going to get through this. And I'll never forget, it was in the spring of '09. The company also was getting investigated on an sort of corporate espionage thing. They had hired somebody who'd taken some boxes. The company actually had sent them back. But anyway, and there was a headline story in the Wall Street Journal about that. And I talked to Chris Nassetta, the CEO, who's still the CEO, and I was at a Hilton board meeting yesterday in Tyson's Corner, and I said to Chris, the company's in dire financial straits. We're about to be indicted or whatever. I said, well, the good news is it cannot get any worse than this. and ultimately, we put in more capital. We got through that legal matter. The business turned cyclically. The management team did just a phenomenal job. And we ended up taking the company public. We made $14 billion. It was the most successful private equity or real estate private equity deal of all time. And the biggest takeaway from this to me, though, as an investor was, even though we overpaid, we had too much leverage, we had bought a great business in a great neighborhood. And maybe, therefore, we shouldn't obsess so much whether we pay 99 or 101 for a company and what page 58 of the model says, but maybe we should focus a lot more on the first paragraph. Mm-hmm. And maybe what matters is, today we'll get to it, what's happening in AI and digital infrastructure and energy and power, or the rise of India, or trying to find some of these amazing neighborhoods with long-term tailwinds. That's what really matters. And how can I invest in those good neighborhoods? And that, plus trying to maintain the level of equanimity, were the most important things. And yes, when you got to COVID and we shut the global economy down and we had a bunch of businesses that had no revenue, you learn from that. The last month, during all the tariff turbulence, remembering this stuff can pass. And I think particularly for those of you who are in the investment world, I think it's very valuable. And I always say to my kids, and I now say to our employees every week, stay calm, stay positive, never give up. And that's sort of my motto and watchword. And I think in these difficult moments, I have to remind myself, but I think it's important to do that.
That's excellent advice. And I will be wasting an opportunity with you sitting here not to delve a little bit deeper into some of the sectors you were talking about in investment. So I want some investment advice. I want to understand what are some of the sectors, what are some of the areas where people should be thinking about that are going to play out well. And in particular, I'll take some advice from you on a personal level. My daughter, who lives in New York City, has been telling me, Dad, just buy me an apartment here. Tell me, has New York City come back? Will New York City come back? What is your bet? And there are a lot of people who live here, who have been here for a while. I mean, we look at what is happening in San Francisco. Let's look at the other side of it, what's happening in Miami. Where is New York City, and what would your bet be on that?
I would bet on New York City. And the reason why I would bet, and by the way, I would bet on the recovery in San Francisco. People, the natural state is to live in these urban centers with super dynamic people from all over the world. There's an ecosystem in these places. There's culture, there's restaurants. They're very hard to replicate. Now, they do go through cycles, and we've seen that. And when the crime rates go too high, the quality of living deteriorates. The taxes are obviously an issue in these places. They can drive people out. And we saw that certainly in the 60s, 70s, 80s. And then shortly after COVID, we had a lot of people, or during COVID, but then after, who left. But ultimately, I think the economy is going to be driven by knowledge workers. Those knowledge workers like to be in these places. And so as long as the conditions return to sort of their normal state, people will come back. And as it relates to your daughter's apartment, the fact that no one is, this is free advice. I'm
taking it. I'm noting it down. Believe me.
That is, as long as no one's building and there's virtually no construction of real estate in New York, and yet there are all these people, look at all these talented grads from your university who want to come and work here, then by definition, if you buy existing stock, it will grow in value over time. And we've also been in a tough few years, both COVID and then the sharp increase in interest rates, which have, have kept values under wraps here. And now with the lack of new supply, I think things can be a lot better. So if you wanted neighborhoods, I was going to give more neighborhoods metaphorically. I wasn't going to go into neighborhoods in New York.
I would love to have the block and the street number as well, if you can, but...
Well, it's interesting. Everybody's buying downtown. I think the Upper East Side is pretty cheap, to be honest. But there you go. So I would say, look, I'll just start, since we started on real estate. There is a shortage of housing in most developed markets in the world. That's really gotten quite pronounced since the financial crisis. And so I would generally say owning rental housing is a good neighborhood. And it's been hurt the last few years by the sharp rise in rates, cost of capital. That, I think, will reverse itself. But even more importantly is the supply-demand dynamic. The biggest trend to keep our eyes on is obviously what's happening in technology. Mm-hmm. And I was talking to the head of AI at one of the big hyperscalers today. And the pace of change, how rapidly these large language models are improving, is extraordinary. And the questions they can answer are just amazing. And I think we're at the very, very beginning. It's almost like basic science in a hospital sense. You've developed the basic science. It's still not made its way to the bed, clinical use, but it's coming. And the same thing's going to happen here. And it's going to change, obviously, coding and customer engagement and creative industries. And we're all going to have these bots. And as a result, what have we done? We've become the biggest investor in the world in data centers. You know, I think we have something like 80 plus billion that we either own or under construction today. And that is the physical infrastructure today for what's coming in this world. Energy and power. So if you believe these data centers are going to exist and consume lots of power, if you believe there are going to be tons of autonomous vehicles, why are we driving cars when it's already clear that these things have a 98% lower accident rate? It's only a matter of time. And why will we not have robots, not just chatbots, doing lots and lots of things? And what is the one constant in all the things I've described? It's energy and power, which has basically been flat in terms of demand for the last 25 years, and now is starting to grow 4 or 5% a year. So own utilities, own transmission lines, own generation, renewables, the whole thing. And then equipment providers, electrical equipment, a lot of boring businesses, utility services businesses, own that whole ecosystem. When you find a great neighborhood, you really want to flood the zone. Mm-hmm. I would say life sciences is another area that I think will be accelerated a ton by technology. And therefore, the labs that do the trials, the physical buildings, the companies that run the trials, phase 3 drugs, there'll be all sorts of industries that benefit from this. I mentioned India geographically as a place that I love because of improving capital markets, legal, physical infrastructure, and a highly educated population, very low base you're operating off of. Alternatives, the industry I operate in, we're watching the rise in asset management. It's obviously ETFs and index funds on one end. It reminds me of retail where you have hard discounters, Aldi and Costco and Amazon, and then you have luxury goods. And there's a little bit of that, if you think about it, the alternative space where it's not the lowest fees, but the net returns have been so strong for such a long period of time. And so that's an industry, and we buy stakes in other managers and secondaries, and then we make loans to private equity firms as well. So I could go on, but I would say identifying these big mega themes and then leaning in a big way, to me, is the best way to generate returns.
That's awesome. So you mentioned so many things there, and I have so many questions, but we will start taking some questions from the audience also in a little bit. But let me just get through a couple more things that just spurned from this conversation just now. There is so much going on in artificial intelligence, and a lot of investment is going on. It's not clear that all of that investment will play out the way people are thinking. It's some of it is just fear of missing out, that people are investing in creatively. How do you make those investment decisions? You are sitting on so many committees, so many things. How do you evaluate what would be appropriate in something like that or not? Which sectors in AI?
It is so hard. I mean, if you think about these large language models and the competition, it's very hard for somebody as a layperson like me. Like, how do you pick? We've generally not engaged in that. That's why I love the infrastructure around it. If you think about this image of the picks and shovels, you don't know who's going into that tunnel in Northern California in 1840, but you know they're going to need jeans and they're going to need those picks and shovels. So that's one way. And then, you know, what we're spending more time on is the AI application companies. Are there companies who can use this technology and within an industry? The other thing we're starting to do is really focus on traditional businesses that are rules-based, that can apply the technology to make themselves much more efficient. So what do I mean by rules-based? Think about accounting and tax, legal. Think about all the zillions of healthcare and financial services transactions. There are clear rules. You know, the ball comes down, the blue ball should go here, the green ball here, and so forth. Can't a machine do that much faster or in partnership with a human being? And so we recently bought an accounting firm. We've been looking at some of the BPO companies, the outsource companies, that have normally been very heavy, human intensive. Can you make them much more efficient? And so I think trying to figure out how you apply this stuff to, in many cases, and it'll be old line businesses, could be really interesting. But nobody can sit here and say, or I certainly can't, this company's going to win versus that company. I would say OpenAI seems to be in a very special position today because their technology seems to be the best. And they built up this consumer brand name, and they seem to be moving in a very strong spot. But who knows? And obviously, NVIDIA as the leader in the GPU space. But we've tried to, I think, not engage as much in figuring that hardcore technology out, more into how can I support it with picks and shovels, and where can I use the application in traditional businesses to drive returns.
Great. So there are so many things to, again, follow up on there. Is there any intuition that plays a role in
Intuition. Yeah.
Or in risk management or geopolitical risk that you're facing?
Is there an intuition? Yeah, I mean, so much of what we do as investors is intuition-based. I mean, I'd love to say it's purely like this is the math, but you meet a CEO and she or he is incredibly dynamic and it gives you a confidence level. When you're dealing with things like geopolitical, when you think about the tariff situation, you know, we obviously had investors who got very concerned. And I'm sure people were like, oh, I'm selling everything. The world's coming to an end. And we were counseling people that, hey, this is policy induced. It's not the financial crisis where we have trillions of dollars of extra debt. It's not the COVID crisis where we're all at home in our pajamas. This could change quickly. So, and ultimately, the administration wants economic growth. So let's be a little patient to watch the tariff diplomacy pay out. So that's an intuition about that. There's a combination of both your numeric sense and your gut sense about things. And sometimes you get it wrong. I mean, you know, it's a little bit like being a baseball hitter. Now you need a higher hit rate than 300 in investing, but you're never going to get it all right all the time. And even Warren Buffett, the greatest, has made plenty of mistakes, and he'd be the first to admit it. So, but I do think a little bit of an intuition about where things are going, what the quality of the business is, and the neighborhood you're in. And then, of course, the price you're paying. Because you can buy a great business in a great neighborhood, and we saw in 2021 or 2000, you could pay a price that doesn't make any sense.
Great. So if you have questions, just raise your hand. I hope there is a mic to go around there. But while people are doing that and the mic is
they want them to, okay?
Yeah. Oh, they want us to be here. So there is
like
sorry,
a town
if you
hall
could come
here.
to the...
Hopefully you won't insult us.
I guess you'll have to come to the mic. So you have to come to the mic there on the side there to ask a question. But let me ask you a question while people are coming to the mic. I've seen some of your running videos on LinkedIn, and I'm very fond of them. They're really fun. I'm just trying to ask, you have been mentioning robots and all kinds of things. Is there a robot who is running with you to take those videos, or how are you managing it? And there's a second question.
Okay.
I want to know if this is something patented, or can I copy that and be on LinkedIn myself while running?
You can be on LinkedIn. There's no patent. I will tell you the technology is very advanced. I go like this. So the backstory on the running videos is I was doing it. I didn't really want to go on social media, and our corporate affairs team really pushed me. And I originally was doing LinkedIn posts that were sort of corporatist and boring. And then I was in Sydney running by the Opera House, and I was like, this is amazing. So I'm like, you know what? I'm going to do a video, the kind of video I would send my daughters. And instead I made it, business oriented. And I said, I love being here. This is a great city. We have incredible people. We have wonderful clients. I'm excited about da-da-da-da. And I posted it, and it went viral. And so I'm a genius, right? I'm like, oh, that worked. I'm going to do that again. And so you can do it in Japan, and you can do it in Bentonville, Arkansas, and you can do it in Paris and London and wherever. And, you just have fun when you do it, and you try to, I would say there's a business reason for this. It's not just some sort of narcissism, like, hey, I want everyone to love me. It's basically this idea that if you think about the investing business, it's a trust business. We're not selling a product. We're selling the idea that you're going to give us your capital for 3 years or 5 years or 10 years or whatever, and you should trust us. And if you show that you're human, and it's very hard on TV when you're being interviewed and the questions are very hard and whatever, to show a lot of warmth and authenticity. And in a print interview that you speak for 45 minutes and they take one controversial statement and that makes it, and I understand that's their business. But what's nice about this is you can show who you are as a person. And I think it's helpful. And it's also helpful when you're recruiting, because people will come in and say, oh, I'm excited to interview. I've watched your running videos. You seem like a nice sort of dorky person. This would be good. So it's become fun. At some point it'll be too much, but for right now it's working. So we got a good line.
Yeah, kindly introduce yourself very quickly, and then let's get a quick question.
Sure. My name is Sandeep Mukherjee. Nice to meet you. Thanks for taking the time. So I had a quick question kind of in regards to your answer about going through turbulent times. So the idea of normalcy and the idea of waiting that out is really important in investing. But given all the things that you just said are changing with AI and everything and the technological growth, what does that new normal look like? And then how do you reconcile what you've known for your entire investing career with the new world that we're experiencing in the next 10 years?
Yeah, it's a great question, because I agree, when there are secular shifts versus cyclical, identifying that's really important. So what do I mean by that? What I mean is, if you're going through an economic downturn, a rate shock, or, we've been through this tariff diplomacy, or whatever it is, COVID, a lot of these things are cyclical, and we're going to get back to some settled place. When you're dealing with a secular challenge, so today you're the CEO of a landline phone company or a department store chain, the cable industry, things that technology has moved in such a way that you're under enormous pressure. There you've got it. You can't just say, hey, I'm going to wait this out for 30 days and people are going to install more landline phones, right? And so I do think it's very important, as you're diagnosing a problem, a crisis with a business, is this cyclical or secular? And so if you go back to my Hilton comment, I saw the downturn in travel. We saw it as cyclical in nature, and that's what gave us the confidence to get through. If a problem is fundamental, is secular in nature, then you've got to figure out, how do I cut my losses? What can I do here? Because things are not going to turn your way.
Great.
Good evening. My name's David Zweighaft. I graduated before most of these people were born. I run a forensic accounting firm here in New York, and I'd like to know, what do you consider to be the greatest source of systemic risks in the economy right now and maybe in 5 years?
Well, look, I think if you said what are the biggest risks, I'd say obviously the size of our fiscal deficit, which I don't think is an immediate problem because there's so much economic dynamism in this country and desire to invest in it. But I don't think you can run 6-7% deficits as a percent of GDP in perpetuity without there being some significant cost. And I think, and by the way, it's not a Democratic comment, it's not a Republican comment. The deficit has continued to grow and accelerating growth under both parties. So I would love to see us get on a better fiscal path. I don't see that as I said, some sort of imminent problem, but you just can't do this forever. I think politically, switching gears to Europe, I think holding that thing together, given the demographic challenge, now the immigration challenges, the lack of economic growth and opportunity, they've had an incredible run holding it together despite all the stresses and strains. But I think it's important they reform and get faster growth. And in some ways, the shock of what's happening from this administration may turn out to be beneficial to them to force them to change some of their policies. And so I do believe there are some risks there long-term holding that together. And then longer term, I guess, to this technology, what does a world look like when you have bots doing everything and so forth? And what are we all going to be doing? I don't think that's tomorrow's problem, but that's something society-wise we're going to have to figure out. I will say on the positive side, I do think a bunch of these geopolitical hotspots later we get to resolve the next little bit, because I don't think the last few years paid off being an aggressor. And so I think we'll see something come out of the Middle East, Russia, Ukraine, and I'm hopeful that the tensions in the South China Sea come down. So that's my optimistic nature, but I do believe that's the case.
So, John, you may not know it, but you have a hard stop at 7:15, I'm told.
Okay.
So we can take one more question.
Okay.
Perhaps two questions.
No, if I go over a little bit, it's okay.
All right.
I'll get it.
Then you are in control.
I'm in control. So we'll take a couple more. I feel badly.
All
We'll
right.
do fast ones. It's my fault. I've been long-winded. Sorry.
Yeah, I'll be quick. My name is Kunj. Thanks for taking the time to come today. A little bit more granular question. You talked about turbulence and also intuition. Just from your perspective, how concerned are you with carried interest and from going from long-term to short-term potentially, and how do you think that's going to affect Blackstone going forward?
Look, I think what's been in the tax code for a long time has worked really well to raise risk capital and build what I think has been an important industry for this country. We'll have to see what comes out of the political process, and whatever it is, those of us involved, whatever the tax rates are, you've got to deal with it. So I think we'll have to wait and see.
Good evening. Thank you for being here, Mr. Gray. Under your leadership, Blackstone really paved the way for innovation and scale, especially in the private markets. And as you've been discussing a lot about innovation and technology applied to financial markets specifically, how does Blackstone see their development in real-world asset tokenization and how it fits into the future strategy for Blackstone, especially given that competitors like Apollo and BlackRock are...
Yeah, moving towards tokenization.
Yeah.
I find tokenization is challenging in private assets because they're not the same. When if you take a big office building one next to another, it's different, or two companies. And tokenizing, I think, really lends itself when there's more homogeneity. And so I'm not sure the private markets will be the first area where we're going to see it. I love distributed ledger for lots of transactions, but I'm not sure it's going to be tokenization in this market. I do think private markets are going to grow a ton, given we didn't really talk about private credit or what's happening in the private wealth arena. But I'm probably, and maybe I could be wrong, but I think it's a hard thing to do because you need to see, touch, feel these things. And it doesn't align perfectly in my mind with tokenization.
Thank you. Appreciate your response. Have a great evening.
You too.
I'll just do the phone.
Yeah.
Hi, my name is Zafa, and thanks a lot for the talk. Being into AI research, I heard you mentioned a lot of AI models and large language models. So the reason why a lot of financial institutions don't use it, is it because of it stems from that the models themselves are not explainable, or is it because there's like this general apprehension behind sort of delegating the tasks to a machine rather than a human in the loop?
Well, the funny thing is, and I was talking to an AI scientist today, large language models are actually not as good at numbers as they are with words because they're language-based, which is actually a fascinating. Old compute was in some ways better with numbers, but I'm sure they're going to figure out how to get there. I would say the problems are all just in the application. I don't think there's resistance from companies to use these tools. So if they could find that the customer engagement or these things could solve all their database problems, and it would be so much easier if you had a query and you could just speak to the machine and say, I want to know what we did, last month, how did that compare, and articulate it and came up. I think companies will embrace this. So I don't think it's resistance from the companies. I think it's applications that work. And doing that is hard. But if you go back in time and you think about the evolution to mobile, that took time too. It took 4 or 5 years before most company went from being on our desktops to having mobile applications. So think of this as it may take us 5 years, but the path of travel is towards adoption here. And once it starts happening, it'll become a competitive necessity. And every boardroom I'm in, we're talking about how we can do this, but the applications are still behind, I think, the basic technology.
Mm-hmm. Thank you.
Hey, my name is Sahil Trivedi. I'm a second year at Georgia Tech. Thanks for taking the time to come speak. I had a question related to insurance. I know private equity has been increasingly present in the insurance market. Do you see that as a secular trend of since private equity companies are able to benefit from the float in the insurance, that it's just more lucrative for private equity companies to take on insurance holdings compared to legacy insurers, and that's like a drift away from legacy insurers dominating the market?
So I guess I'd say on insurance, the private equity firms are doing it a little differently. On the front of the house, we're all doing the same thing, which is we're adding more private credit to the portfolios of insurance companies, which in most cases are the same or higher credit quality, but are higher returning for the insurance balance sheet because you're bringing the insurer right up to the borrower, making those loans and taking out a lot of distribution, origination, securitization costs. So that will continue because whatever produces high returns tends to attract more capital. We as a firm are choosing to do insurance asset management purely on a third-party basis, not as a balance sheet insurer. Some of our competitors have chosen to become insurance companies. I think they're going to be successful. It's a different path. And in that case, yes, they get the benefits of float and they're doing spread and they issue annuities or life insurance policies and they're managing that money. And so they view that as an attractive way to raise capital. We'd prefer not to have a balance sheet and just be a third-party manager. But the key driver of this, I would say, is the increase in exposure to private credit. And that's what's driving the phenomena.
So, thank you.
Thank you for taking
these are the last three, and then we're done.
Thank you for taking the time to speak with us. My name is Bhavin Shah. I'm a freshman at Georgia Tech. I'm really interested in sort of the secondaries market. And know you guys just recently closed a fund for $22.5 billion. Wanted to know how you guys plan on deploying that capital. Would you believe that's like a testament to the sort of current assets that you guys are holding in a lot of your funds? Or do you guys plan on seeing an increase in sort of the amount or sort of a discount to the current valuation of a lot of assets in other funds?
So the secondaries business is basically buying private equity, real estate, private equity, credit, infrastructure, interests in funds that our LPs have who are looking for liquidity. And as alternatives keeps growing, the one challenging thing is how do you get liquidity? And secondary fund investors do this. And we have the largest business in that space, about $90 billion of total assets. We have a $20+ billion current fund in private equity there. And I would just say there's a lot of need for liquidity because a lot of investors have been patiently waiting. They haven't gotten their capital back. And so they're looking for a way to get liquidity. And so they're looking at the secondaries market. There also now are endowments who are under more pressure given some of the things that are happening in Washington. There are some countries overseas who are looking for liquidity for a variety of geopolitical reasons. So it feels to me like it's an industry still in its early days. And as long as alternatives grow, I think you'll see growth in secondaries.
Sounds good. Thank you so much for your answer.
Hello, thank you for the talk. My name is Adam. I'm a student in Professor Messner's class. And I had a question about like commodities and even like tech-based cryptocurrencies. And what is like your approach to investing in these? And are these like valuable or is it just speculation?
Well, what I would say about the crypto world is I understand why people are saying, hey, look, I'm looking for another way to store value. Governments are running very large deficits. They're printing more money in many cases. What's something else I can hold on to? Gold has obviously rallied, and this is another form of savings, they would say. For us, the challenge is we invest in things that produce cash flows that we can discount back. So we don't invest in gold. We don't invest in Swiss francs. And it's not because we don't think it may make sense for some investor portfolios, but I can't come up with an economic framework where I can say, you know, Bitcoin should be 80,000 or 200,000 or so forth. So I'm not dismissing what others are doing. I think obviously people have made enormous amounts of money, and I understand the desire for another place to be a storehouse of value. But for us, we're going to invest in things that produce cash flow. We can discount back that infrastructure, real estate, that business. And that way I can tell our investors I have confidence I'm making a good investment. This would be much harder for us.
Thank you.
Hey, my name's Scott. You mentioned Warren Buffett, and he started to run into issues in 2012 and 13 as he started to scale. You and your peer set are scaling, double, triple, and quadruple, sometimes higher. How do you think long-term Blackstone will perform if you continue to scale on the path y'all are going?
So it's a question we get all the time. And what I would say is a couple of things. One is there are huge advantages in our business from scale. One is from the data and insights we get. Two is from some of the platforms that enable us to do things. Three is in private markets, there is, it's more efficient to be larger because in a sense, if you think about it, if we're buying a public security and you were buying $1 million and I was buying $100 million, I would move the stock, you wouldn't. But in private markets, if I can write $1 billion check to lend to somebody, or I can write a multi-billion-dollar check to buy a business, then I may have very limited competition. And so the scale has proven to be advantageous. I think probably the most important thing, though, I'd say is when you look at the growth of our firm, we've grown in private equity, we've grown in real estate private equity. But if you look at that, that hasn't grown the same multiples you've described. What's happened is we've expanded what we've done. And we're doing many things today that are lower returning in much larger markets. So if you think about core plus real estate or infrastructure or performing credit, investment grade, non-investment grade, we've gone into massive markets that we previously didn't deploy capital in. And if you think about returns almost like a pyramid, you're right, at the very top, the highest return, that's smaller. But as you start to move down that return pyramid, there's a big universe. And that's where you've seen the bulk of our capital raised. So in the last year, more than half of what we've raised has been in private credit, which obviously is an enormous marketplace. So for us, the true north in our business is delivering great returns. We never forget that. And I would say even as we've raised more capital, you can look at our track record, we've continued to deliver returns. And that's what we've got to do as a firm. And for anyone going into the investment business, that's the most important thing. It's like you run a pizza shop. Your pizza shop can look great, could have good music, nice people. But if the pizza tastes bad, no one wants to come. So you got to have great returns, and we never forget that. So
Thank you.
There we have it. Thank you very much, John.
very much.
Thank you very much.
Thank you.
And thank you for staying longer than that. By the way, and thank you all for joining us today. And I would like to invite you to the Future Tech Talks business. We will be back in New York on September 16th. And our guest will be Stephen Squeri, CEO of American Express. I hope you will join us for that as well. Thank you again.